Hello traders, how is it going? We are currently in the last second week of 2021. We have one trading week left next week and we are done with this year. Unfortunately for us, market performance is quite lackluster since November, but this isn't anything new as we have faced multiple up and down during our trading journey of 2021. And personally for me, this is the most exciting time of the year for a totally different reason. And that reason is performance review, my personal performance review, or Nimbus Capital performance review. At this time every year, I will look at all the close trades that I have recommended on Patreon and those that I have personally taken for the year. I will look at my trade journal. I'll look at the statistical data to see if there is anything I should worry about, anything that I can improve. And of course, it is also a good time to review our performance. And if you are someone who have been following Patreon's trade setup throughout the year, right, this is a good time for you to review your own performance as well. As this is a public video, I believe there will be three kinds of viewer who are viewing this. The first group is those who are not subscribed to Patreon. So most of the stuff you see here might be new to you, but this video may also serve as an introductory to what Nimbus Capital do and our overall 2021 trading performance. And if you feel that our performance is acceptable for you, then you can look to subscribe because we share a lot of trade setup and I personally take some of the trade setup that I share. The second group will be the long-time subscribers of Nimbus Capital Patreon or my fans, my fans or my course trainee. You guys are probably the bulk of the viewers, so you have complete understanding of all the concept and terminology and the strategy that we use. So I'm not really worried about you guys. And the third group will be that those who just join the subscription or those who just come to be a part of Nimbus Capital not long ago, probably in November or maybe in October. So first and foremost to this group, right, I would like to extend my apology that your timing of subscription to our Patreon is not the most optimal because market has been facing some retracement and the general sentimental fear level is the highest for this year. So you come in at a time where even Nimbus Capital ourselves is facing the biggest drawdown for 2021. But worry not, as good traders are trial and tested. Good traders are born during bad times, and we shall emerge from this retracement better and stronger. For those who are familiar with how I perform trading, you will know that I love recording and analyzing data, trade data, because this is our best chance of improving ourselves. And in this video, we will go through all the trades that we have recommended for 2021 on Patreon and the statistic behind these trades. And I will try my best to ensure that all three group of viewers are able to understand and not get confused. So let us begin. For the year of 2021, we have a total closed trades of 135. This averaged to about 11 closed trades every month, and we currently still have 30 open trades that we recommended or entered during the past 3 months. Now, this may seem like a huge number, but the thing is, you have to understand, you are not supposed to take every single trade setup that I have shared. From the perspective of someone like me who is recommending trade, you must understand that viewers and subscribers come and go. So someone who just joined the Patreon, right, they might miss out certain trades that I share 1 week earlier, 2 weeks earlier. And if I stop sharing just because I shared something previous week, right, then this trader is going to be left out. So as long as the market is healthy and the chart meets our entry criteria, right, I will continue to post trade recommendation. There have also been suggestions that I only share the trades that I take, which I don't agree at all, because if you look at the trade data, which I will be sharing later, right, I personally take about 50 trades this year, And if I only share the trades that I take, right, then I might not be sharing stuff for like 1 month or 2 months already. But at that same time, there could be a lot of good potential that you might have missed out also, because I'm not taking them, I'm not sharing them. And in fact, if you look at our trade data, right, there are definitely a whole chunk of trades that are very good, but I did not take as well. So don't have to be too worried about that. And the main reason why I am not taking all the trades is I have limited capital. So do bear that in mind. Do bear that in mind. Next is that because Nimbus Capital have a strict set of entry criteria that we follow religiously, we have a bunch of checklists. So you do not need to worry so much what are the trades that I'm taking personally, because they all have the same entry criteria. Hence, they have the same winning probability. And this has been proven by the statistic, because if you look at the chart here, the total close trade is 135 with 87 win and 48 losses. This gives us a winning rate of 64%. And the trades that I personally take, I have a total close trade of 47 with 30 profit and 17 loss, which comes up to also 64%. So this is like the winning rate is exactly the same, whether you are following me or you don't follow me, or whatever trade you take, right? As long as you manage your risk well, as long as your lot sizing is standardized. By standardized, I mean that if you enter $2,000 worth of trade for this counter, make sure you are doing the same thing for every other counter. You don't go and enter 10K for one trade and then the other trade you go and enter 1K. So that is not standardized really. Okay, so you can see that the winning rate is almost the same. It differs just by a decimal point. And there is something that I want to discuss a little bit in length on the winning percentage as well. Nimbus Capital do not shy away from announcing our losses, and we are as transparent as we can with regards to our trade setup and recommendation. So as with all statistical data, right, the law of large number is in effect. And because we are dealing with trading statistic, the market condition is also a very important factor. Hence, right, if you are trying to work out the trading winning percentage for yourself, you cannot arrive at that number by simply using 10 close trade during a bullish period, because that is not representative enough. 10 is not a large number. And perhaps that 10 trade is during a period where market is going up. So your data only account for one type of market movement, and that by definition is not representative enough. And I believe that 135 close trades across 1 year is a good representation, as we have been through about 3 minor market correction in the US market. Singapore market is generally sideways for the entire of 2021, and Hong Kong market has been in downtrend since March. So we do have quite a good mixture to ensure our 2021 data is representative. Yes, it is true that we have a 64% winning rate, but since we are dealing with trading, right, what you will notice is that this winning rate is not evenly distributed, like say flipping a coin. So during an uptrend, you will see that the frequency of our winning rate is skewed towards the upper percentile. And at one point, right, our highest winning rate was like 72%. I think for those who have been here long enough, you will remember that period very clearly. I myself was quite impressed that, wow, my trading system at 72%, but that was during the bullish period. And when we are faced with market retracement, we will start to see a string of losses, and this is evident in our trade data as well. As a trader, right, this process is unavoidable. If you choose not to trade the uptrend in fear that market might retrace, then you might miss out if a rally continue to get extended. and the whole thing just keep going up. Hence, it is always better to trade the trend while we employ risk management to limit our loss if we get caught in a retracement. And that is why stop loss and risk management are extremely important. So this is where we will introduce our first advanced trading statistical concept, the risk of consecutive loss. As we explained earlier, right, during market retracement, we are bound to be hit with a string of loss, and we call this back-to-back losses or consecutive loss. To ensure our risk is properly managed, we need to have data of two parameters. Number one, what is the maximum consecutive loss that we can get during market retracement? Number two, what is the probability of getting this number of consecutive loss? Meaning, let's say during market retrace, am I going to lose 5 trades in a row? Am I going to lose 6 trades in a row? And what is the chance? What is the occurrence of such a back-to-back loss? So, of course, these two parameters are largely determined by your entry strategy and criteria. And if your strategy change, then this number will change as well. And the only way to get this number is to forward test your strategy. You do a forward test, maybe for 1 year, and then from 1 year, you can look at the data to see what is the occurrence and what is the maximum number of consecutive loss that you can get. Of course, if you are following Nimbus Capital Trade, let's say you are subscribed, and since we already have the forward test data, right, you can just simply leverage our data. You don't need to go and do all the forward testing on your own. So with that said, if you have your own trade strategy, right, then it is paramount that you go through this process of data collection to get these two numbers, because these numbers are very important. They will determine how much risk you can take. So why do we need this data? Because it allows us to prepare and expect what is our maximum drawdown and the probability of that said drawdown occurring. Drawdown is the maximum amount of money you can lose at one go. So for example, if you take 100 trades and you have to check what are the occurrence of getting 2 back-to-back loss, 3 back-to-back loss, 4 back-to-back loss, and so on. The more trade data you have, the better. So based on Nimbus Capital Trade Statistic, we can see that we are often faced with 3 back-to-back losses, and it is very common for us to lose 3 trades in a row. So it's very common, but we do not see 7 consecutive loss. And the worst we have so far is 5 back-to-back losses. So we have this number 5. Now that we have this data, we actually know what to expect from our strategy and the risk management during market retracement. If we risk 5% of our capital per trade and we lose 5 trades in a row, then we are going to see 25% of our capital gone at one point. And since we frequently encounter 3 back-to-back losses, right, we will often see our account dropping 15% because 3 times 5%. And if we look at it, right, these risk number are slightly high and dangerous, and that is the reason why we do not take 5% risk per trade, because I'm not used to seeing my portfolio drop 15% very often. So that's not the risk I'm willing to take. So there is a reason why Nimbus Capital recommend 2% of your portfolio per trade to risk. And this is to ensure that if we are hit with consecutive loss during retracement, we do not lose so much. And it is because of this data and risk that complement this data, we are prepared and confident of our position, even in the worst possible market situation. This is the chart that I shared previously. And you can see that on this table, right, the risk of consecutive loss is based on 500 trades and 1,000 trades. However, this data only apply for Nimbus Capital strategy. So to summarize this session, your winning percentage is important, but you have to account for market movement and the risk of back-to-back losses. Trader who make a lot of money during bullish moment, then over-risking can not only give away their profit, but they can also lose their entire account if they come face to face with this back-to-back loss unprepared, or they are not aware of how much back-to-back losses that they can encounter. You have to understand trading is not a lottery. You are not going to YOLO bet very big and then you make one big winning trade and then you are like out of the trading. No, trading is not a sprint, and that's how most folks become bankrupt, or that's how even trader at the highest level lose billions and millions of dollars because they are over leveraging and they are treating trading as a lottery. So if you are going to be a sustainable trader, right, you need to have a sustainable system, and a sustainable system would means we must sometimes forego risky YOLO trades for big profits, but in return, right, we can survive and we can earn more in the long run. So by following Nimbus Capital Patreon, you are able to leverage on our powerful statistical data that we spend years and years to obtain, and we are also continuously updating. With that said, the next matrix I would like to look through is expectancy and risk-reward ratio. These two are important because they are the so-called a trader's performance indicator, our KPI. First, I want to talk about risk-reward ratio, and this is a touchy topic because many traders misunderstand this matrix, and even among experienced traders and guru, they promote risk-reward ratio as their main measurement of trading performance. And I will try my best to respectfully explain why judging a trade system based on risk-reward ratio alone is misleading. Let us imagine a hypothetical scenario with two biased coins. And if you are on my Facebook group, you probably have read this already, but just bear with me for the next 1 or 2 minutes. So let's say the first coin have 30% chance of flipping head, and it has 70% chance to flip a tail. And if someone bets with you that for every tail flip, you get 90 cents. And for every head flip, you will need to pay him $1. So the risk reward ratio here is 1:90 cents, or simply 90 cents. Meaning for every $1 you risk, you are only getting back 90 cents. Now, the second coin is a fair coin, meaning it's a 50% head, 50% tail. And someone bets with you that for every tail flip, you get $1.10. And for every head flip, you will need to pay him just $1. So the risk reward ratio here is 1:1.1, or for every $1 you risk, you have the chance of getting $1.10. So obviously, from a risk reward ratio perspective, you will go for the second coin. That's on a surface level. And let's say if you play 1,000 flip with both coins, right? What you will realize is that you will theoretically earn $330 from the first coin. But on the second coin, you will only earn a measly $50. So why is it that a higher risk reward ratio system have a lower payout? And obviously, there is a second parameter in effect, which is your winning rate. Hence, we will use a different matrix, which is expectancy. Expectancy formula will account for the winning rate as well as your risk reward ratio. Hence, it is a much better performance indicator. However, expectancy is still incomplete as it still lacks a third parameter. But for the purpose of this video, right, and to keep things simple, we shall not go through the third parameter. Expectancy is sufficient for now. By using the expectancy formula, you can calculate the expectancy for both coin systems, and a positive value will indicate a profitable system, And the expectancy number represent how profitable is the said system. And we can see that the coin with a lower risk reward ratio is actually more profitable because of its higher winning rate. So what I have just shown here is a pure mathematical explanation that a higher RRR is meaningless, is totally useless if you do not know the winning rate of the system. So I must stress that these calculations are theoretical based on coin probability. If we were to physically flip the coin 1000 times, you will see that the real data should not differ much from its theoretical calculation because since it's a coin. But when we move to trading, right, things get a little bit complicated because trading is not like a coin flip where the winning probability can be mathematically calculated. It's not like rolling a dice or it's not flipping a coin. The only way for you to know your winning rate is to have a forward tested data over a large period of time and through different market conditions. This is something we mentioned earlier. So when we talk about risk reward ratio in trading, there are actually two forms of risk reward ratio. New traders, right, or sometimes even experienced traders, they are unable to differentiate or even realize that there is actually two forms of risk reward ratio. So much like coin flip probability, right, trading risk reward ratio also have theoretical and actual. So if we look at coin flip, a theoretical will be 50-50. But is it really 50-50? You need to physically flip the coin to go and find out. But of course, in the case of coin flip, your theoretical and actual, they are very, very close. The data you get will be very close. So for most new traders, they are only aware of the theoretical because they usually blow their account or give up before they have sufficient actual data to calculate what their actual risk reward ratio is. So theoretical risk reward ratio is actually what you put on your chart as part of your trade plan. For example, something like this, when you draw a chart, you draw your trade plan, you draw your support resistance, and then you start drawing your stop loss and your profit level. So this is what you plan. This is not actual data. So you can actually place a stop loss that is as tight as possible, or you can even place your TP as high as possible to ensure that you have a high risk reward ratio. And sometimes trader goes to the extent of claiming that, oh, I will not take this trade if the risk reward ratio is below 1.0. And this risk reward ratio that they are referring to is the theoretical risk reward ratio. And realize that the success rate is not in the equation. You can set whatever TP you want, you can set whatever stop loss you want, but what is the success rate? And that is not in the equation. So you can already see the issue with this because that theoretical risk reward ratio number is pretty much useless if you do not know the winning percentage. And this can be further made complex with discipline issue, because how disciplined are you when you are following your stop loss and TP that you have set out for your theoretical RRR? Are they just there for show? Can they be replicated consistently? Are you constantly exiting before your TP or your stop loss? If discipline is an issue, right, then it makes the theoretical RRR even more useless than it already is. So now let's talk about the actual RRR. The actual risk reward ratio is what most trader ignores, and it's once again simply because most traders don't really have a trade journal, they don't look at their trade data, or they do not survive long enough to have a good set of actual data. And it is very simple to calculate. So what you do is you look at all of your close trade, and your risk reward ratio is your average profit over your average loss, and that is your actual risk reward ratio. So now take note that we are still dealing with RRR. We have not touched expectancy yet. So once you have got your actual risk reward ratio value, right, you can compare it to your so-called theoretical RRR value. And you have to see, are they close? Are they comparable? And if they are not comparable, right, then you have to ask yourself why. If I have a coin that is giving me 60% head and 40% tail, right, then I might start to question the manufacturing of this coin, or maybe the weight of the coin, like there's something wrong with this. So if your actual RRR is different from your trade plan RRR, right, then you need to start asking question already. And most of the time, right, the reason is that traders don't follow their trade plan. And if you deviate too far, it is a sign that the trade strategy is not consistent and traders have discipline issues. And this is often true for traders that will plan with a very high TP and exit way before the TP is reached. So the actual RRR value will show much lower than your theoretical RRR. So with that said, right, let's take a look at our Nimbus Capital portfolio and all the Patreon's recommendation. I have calculated the theoretical RRR for all of our trade setup that we have shared. So we have a average theoretical RRR of 1.20. Now let's look at the actual risk reward ratio of my personal trade. So after I dig out all my data for 2021, I can see that we have a average win. This is average, average win of $2,912, and my average loss is $2,056, and that gives us a risk reward ratio of 1.42. So if you compare this actual RRR of 1.42 to the theoretical RRR of 1.2, right, you can see that my actual is higher than the theoretical. And this is not even including some of the counters that we are holding all the way from last year, because this data is only for 2021. We did not include some stuff that we have been holding since 2020, such as Propnex and Franken. So if we were to include those, right, then the true RRR value will be somewhere close to 2.35 already, because the profit on Propnex and Franken, even with their current price drop, is still monumental. So our actual risk reward ratio exceeds the theoretical risk reward ratio, which can imply that our trade setup are consistent and it can be easily replicated. So the implication here is that we can rely on our theoretical RRR as a form of forecasting, and this is a conservative forecast, as our actual RRR is much higher due to the second TP. We do trailing, and we even stack winning position. We add on to our winning position. So on top of that, right, we also have a reliable winning percentage that is backed by forward testing data. And with these two parameters combined, right, you can easily calculate the true performance indicator, which is expectancy. So this level of statistical data is important to me as a trader, because it allows me to have a full knowledge of my trading system and how I can further improve myself. And not only that, this data also provide transparency for followers and like you guys so that you will know what to expect. And hopefully this session will open your eyes to the importance of statistical data. We mentioned this in one of our webinars, that when we are dealing with unknowns and incomplete information, using Statistic is the best approach. And our 3-month course teach this discipline in a much more detail. We still have 4 slots left. So if you are interested, right, you can apply for it, you can register for it. So in part 2, we will go through our expectancy for 2021 and how you can interpret this data for your own benefit. We will also go through the statistical performance for Nimbus Capital trade strategy, and we will explain what is some of our trade strategy means, and you will start to understand these terms that we use in our that spreadsheet lah. And also, please remember to subscribe to our channel and join our Patreon if you wish to start afresh for 2022. It's always good to start afresh from a clean slate. Okay, so I hope to release the part 2 by next week, because I think this kind of video is not easy to make, as I am still going through some of my own statistical data, right? I still need a bit of time to sort of get my thoughts organized, and once I'm done with that, right, I will definitely release the part 2 by next week, and we will be discussing even more in-depth stuff next week, because there are some statistical data that you might not be familiar with but are still very important when it comes to recognizing a trader performance. Okay, so have a good day, guys.